Welcome back to Fiscal Voyage. My name is Felix, and in today's video we're going to talk about a high growth, high dividend yield company with no debt. And we're going to talk about this company and go look at some of the financials, look at some of the earnings and free cash flows and dividend yields, and see is it a good buying opportunity at today's price, and what am I doing with this stock. So we're going to go over all that in this video, but first, if you're new to the channel, make sure to hit that subscribe button and like this video if you enjoyed it and find it informative. Also, check out my free ebook in the description below, and also sign up to my free swing trading newsletter where I provide one free swing trade a week for you guys to take advantage of. So let's get started with the video. PetMed Express Inc., ticker symbol PETS. Right now it's going for $32.70, and we're going to talk about some of the fundamentals and why I really like this company as a long-term play. First off, the yield is very good at 3.67. Earnings are expected to be $1.61 for the year, and currently has a PE of 20, which is kind of on the high side, I think, in my opinion. Market cap of $657 million. So some of the things, if we go to fast graph, you can see here PetMed Express had earnings growth tremendously early in the 2000s. You can see here 100%, almost 300% earnings growth, 33%, 36, 47% earnings growth. So that's great. During that time period for the company. But then, in 2010, 2011, 2012, it had a, drawdown here, negative 19%, negative 13%. But then it grew at a nice, respectable rate, 7%, 5%, 11%, 15%. And then they had a huge increase in 2018, a 56% increase. But this is what I like about this company. They've been growing the dividends very nicely throughout the years. If we look here on the fast graph, they've been growing dividends at a compound annual growth rate of 12.7%, which is like triple the rate of inflation, which is very good. And then we put in the price on the chart. The price is very volatile. That's very obvious with the price chart here. These are monthly closing price, and it looks very volatile. You can see here it's gone from $20 all the way up to $47 in less than a year, and then from $47 in 2 years down to $15. So the price is very, very volatile. But the company itself looks to be more or less stable. If you look at the free cash flow, which is how companies are able to continue to pay out growing dividends, the only hiccup they had was in 2016 when free cash flow was down 97%. But overall, they've been positive free cash flow, so very well covered the dividend. 2022, they're expected negative 24% in free cash flow compared to 2021. But it's still over the dividend payout ratio. But one of the main thing I really like about this company, if we go to Morningstar, you can see here debt to equity ratio is 0, interest coverage is 0. Why is that? And if we look, you can see here the balance sheet, they have no debt. This company does not have debt in their balance sheet. This is outstanding. I love companies with very minimal debt or to no debt. This company does not have debt, and which is outstanding. You don't understand how excited I am for this company. But some of the things that I don't like, if we look at the financial key ratios, and we're going to use the rule number 1 from Phil Town. You could download this spreadsheet. There's a link in the description, as well as a free ebook in the same link. You can download the free ebook and this spreadsheet. So what I do is basically copy and paste your sales or revenue growth. So I go here, I'll copy the revenue and then put it into the spreadsheet here. And then you can see the growth rate for the 10-year, 5-year, and 1 year. And you can see that over here as well. If you go to growth here, you can see it here. But the reason why I use the spreadsheet is because of this right here. I organize this very nicely here, and it follows the rule number 1 from Phil Town. If it's over 10%, return on equity or investment capital, earnings per share growth, sales. So I have a nice chart here so you can see the 5-year and 10-year. And if it's over 10% in any of these categories, it turned green, so it gives me a good visual for that. But you can see return on investment capital is outstanding, over 20%. Earnings it's low for the 10-year average, but it's heading in that right direction. It's going higher. You can see here, earnings 10-year average is 7.4, 5 years 8.3, and then 1 year over year is 17.8. Outstanding. Cash, very good. They had this 5-year average of 8.5, but that's not too concerning. So very solid cash flow with no debt. I'm very excited about this one. Sales also been growing on the uptrend from 2.9% 10-year average to 5.6 5-year average and 8.8 1-year average year over year. So overall, it doesn't really meet the Phil Town rule number 1 investing, but overall I'm very excited because the company has no debt. And then expected earnings, we look at the forecast, you can see here analysts are expecting 13% earnings growth for the next 3 to 5 years. And we go to Yahoo. Yahoo expects earning growth of 11% over the next 5 years. So one of the big things that I'm concerned right now with pets is the valuation. Am I willing to pay $32.70 for this company? It has a blended adjusted earnings yield of only 4.6, and I do a lot of these videos, and I tell you I like to see an earnings yield of 8.5, 8% or higher. So the earnings yield is a concern here. The dividend yield is very good. They don't have an S&P credit rating, but again, they don't need it because they have a 0 debt balance sheets, which is outstanding. But if we look at the chart here, this is the monthly, this is the weekly, and these two are the daily, just in a 3-month period versus like a 2-year or year period. And you can see here a few days ago, the stock jumped from $29 to $46. So that's a big increase in that day. If I own shares, $30 to $27, I would have sold that day for sure, because those type of spikes are rare, and when they do come and you're in it already, take advantage of it and sell and take a profit, and then eventually possibly buy. So what I'm doing is I actually have an alert to alert me when the stock falls under $27.57. And the reason for that, if you look at the weekly chart over here, you can see this under $30, $28, $27 is a good support area for this stock. So if I could get this stock under $27.50, I'm buying. I find this stock to be very attractive under that value, and if it goes under $25 here, this is the other alert here. If it goes under $25, buy a lot more. I'm going to be buying shares. I think the lowest support area will probably be around here, which is $24 to $25. So that's why I have that alert set there, because if I see this stock in between 25 and 27, I'm a buyer, because it'll put it around a PE around 15 or 16. So if you have a PE around 15 or 16 price to earning ratio, this earnings yield is going to increase. It should be over 8%. The dividend yield is going to increase maybe 4 to 5%. Again, no long-term debt, so it makes me very excited for this company. But overall, I like PetSmed Express, ticker symbol PETS. Put this in your watch list. I'm not a buyer at today's price, but if it gets lower, I'll be definitely interested in this company. So I have it in my watch list, and I think you guys should do it as well. Overall, this company is very solid. You saw again the earnings and the uptrend, and they could expect it to continue to grow earnings. And people love their pets and want to take care of their pets. So overall, I'm very happy with how this company been performing, and I'm very excited to be a part owner of this company eventually once the price is in my happy medium zone. So again, you could download the spreadsheet, the rule number 1 from Phil Town spreadsheet. You can download that in the link in the description, as well as a free ebook in the link. So if you're new to the channel, make sure to hit that subscribe button. If you enjoyed the video, hit that like button, and I'll see you guys in the next one.